Good afternoon. Time to have a look at market news. Stocks, treasury yields and oil sank as a new COVID-19 strain discovered sent a wave of caution across global markets. US and European futures fell and the 10-year treasury yield dropping to 1.5%. The dollar was near a 16-month high while the rand weakened and commodity currencies retreated. Crude shed more than 3% and gold rose. Looking at US markets, they were closed yesterday for Thanksgiving, but they'll have a shortened Black Friday session. To talk to us about how all of this is playing out, specifically with our local markets, we did see the all-share futures, JSE futures, a little bit earlier on opening in the red, indicating negative performance, and we're starting to see that as well as we look at the travel and leisure stocks. But to give us the overall picture, we are joined by Jones Gondo, who is a Senior Research Analyst for Credit at Nedbank CIB. Jones, thank you so much for your time. In light of everything that is happening, do you find it quite ironic that it's Black Friday, but it's also Black Friday for market, as some analysts have alluded to in social media?
Well, I think it's just been a very volatile week on the whole for the currency market for bonds, and it's been spurred by risk-off sentiment from abroad, and so it's very little that local market participants can do. They will be price takers in this kind of scenario. But I think you mentioned right in your introduction about how risk capital really driving US yields down, and it's about an inflation outlook. We obviously looking at real yields in countries or emerging markets such as South Africa. And this week we also had Turkey, with the problems around the credibility of their monetary institutions, add to South Africa's woes. And so currently we see the rand above 16 to the US dollar, and its weakest level in months, really.
Right, so let's talk about those hotel and leisure stocks, seeing them earlier on crash between 12 and 20%. This after the UK slapping travel restrictions on South Africa again. For the benefit of our viewers, we are going to have those charts on screen, starting with City Lodge tumbling as much as 20% to R3.99 per share. And then we'll load Sun International and Soho Sun, both of those are dropping 15.8% and 11.2% respectively. Do you find that tourism being the biggest loser in this particular point? And also, on the flip side, would you then want to buy into those shares given where they are right now?
I think it's a very difficult proposition to find value in these stocks. I think we know that finding this additional strain of very little information to go on in terms of the implications, its impact. I think everyone is playing a hedge against future lockdowns or extreme measures by government to see how they deal and respond to this. And of course, I think that's fed into the price of the stocks. And so, at this point in time, no, I don't think anyone is a buyer at this point.
All right, so let's talk about some of the key themes that you think dominated markets this week. I mean, we've had the COVID-19 cases soar in Europe. We've had US jobless claims at their lowest level since 1969. Energy stocks continuing to rally, and of course that continued dollar strength. Which one of those, or perhaps you can add to the list of the ones you think were the key themes, what caught your attention this week?
I think just how strong the USD, the DXY rose, and just how battered emerging market currencies were. I think the important point here is that when you look at US data, it's running hot at pretty much full employment for those who are searching for jobs. And the policy response so far has just been taper. So I think the expectation really is that the US monetary authorities need to respond a bit stronger and maybe a bit faster, because where it started with a narrative of transitory inflation, it looks as if the economy is indeed running hot. And that is obviously having very pronounced impacts on global rates markets.
Right. On that note then, how are you thinking about faster than expected taper or faster than expected interest rate hikes?
Yeah, look, I think at this point in time, everyone's looking to the US dot plots and whether, it was, I think, even just a couple of weeks ago, whether or not they would even hike at all in the next calendar year. And the hikes were really priced into 2023, 2024. I think they will have to push some hikes forward, and I think that's what the market is expecting. If we look at how forward markets had been pricing in now earlier and faster rate cuts, and so the rate hikes. I beg your pardon. And I think the data is supportive of such a move, and we've heard certain Fed deputy governors of the US Fed point to the need to do so. So I think it's justified that the market is typically moved ahead of the policymakers in expectations.
Right. Before I let you go, I did want to talk to you about, some of the fashion retailers on the JSE, but in the interest of time, we'll save that conversation for another time. Key event that you're going to be looking out for as we wrap up the week?
Yeah, look, I think it's because we had the holiday, Thanksgiving holiday in the US, I think there's still more still to come next week in terms of volatility. There's really difficult liquidity to try and trade the markets. So next week it's to kind of see where pricings for currency and bond yields sort of settle down and take us really into starting to look particularly at the corporates. So you mentioned right at the beginning it's Black Friday, and we're expecting big sales coming through. I think it's a story of whether the consumer was in a position to really respond to this. So we'll really be quite interested to see or hear how the market interprets how well this Black Friday went for the local market. But right. I think overall, we're still subject to global volatility.
All right. Thank you so much for your time. That is Jones Gondo, who's a Senior Research Analyst for Credit at Nedbank CIB.